Hey guys, what's up? Hope all of you are doing great. Today our topic of discussion is types of taxes. So let's start the video without wasting the time. Types of taxes. There are several very common types of taxes. Income tax, a percentage of generated income that is relinquished to the state or federal government. Payroll tax, a percentage withheld from the employee's pay by an employer who pays it to the government on the employee's behalf to fund Medicare and Social Security programs. Corporate tax, a percentage of corporate profits taken as tax by the government to fund federal programs. Sales tax, tax is levied on certain goods and services, varies by judiciary. Property tax, based on the value of land and property assets. Tariff, taxes on imported goods imposed with the aim of strengthening domestic businesses. State tax, rate applied to the fair market value (FMV) of property in a person's state at the time of death. The total state must exceed thresholds set by state and federal governments. Tax systems vary widely among nations, and it is important for individuals and corporations to carefully study a new local tax law before earning income or doing business there. Below we will take a look at various tax situations in the United States. Generally speaking, the federal government levies income, corporate and payroll taxes. The state levies income and sales tax, and municipality or other local government mainly levy property tax. Income tax. Like many nations, the United States has a progressive income tax system throughout which a higher percentage of tax revenue are collected from high-income individuals or corporations than from low-income individual earners. Taxes are applied through the marginal tax rates. A variety of factors affect the marginal tax rate that a taxpayer will pay, including their filing status, married filing jointly, married filing separately, single or head of household. Which status a person files can make a significant difference in how much they are taxed. The sources of taxpayers' income also makes a difference in taxation. The source of taxpayers' income also makes a difference in taxation. It is important to learn the terminology of the different income types that may affect how income is taxed. Capital gains taxes are of particular relevance for investors levied and enforced at the federal level. These are taxes on the profit generated when you sell an asset that is increased in value. The rate of taxation on the profit depends on the length of time for which the asset was held. Short-term capital gains on assets sold 1 year or less after they were acquired are taxed at the owner's ordinary income tax rate, whereas long-term gains on assets held for more than a year are taxed at a lower capital gains rate based on rationale that lower tax will encourage high level of capital investment. Tax records should be maintained to sustain the length of ownership when both the assets were sold and the tax returns were filed. So our topic of discussion has been ended. Hope you enjoyed the video. I'll see you in the next video. Take care. Goodbye.